G'day folks, welcome back to another update for the S&P 500 and the NASDAQ. Now both charts have turned neutral since our last update. We're going to also include some back testing to show you the trading methods. Don't forget to hit that like and subscribe button to support the channel. And first, in terms of the outlook as of today, March 27, the earnings outlook, analysts project the S&P 500's earnings per share to reach a record $269.91 in 2025. A 10% increase from the previous year with an additional 14% growth anticipated in 2026. Market performance as of March 26, the S&P has declined over 3% year to date, while the NASDAQ composite has experienced a 2% drop, led by significant losses in major tech stocks like Nvidia and Tesla. Economic concerns. Despite optimistic earnings forecast, there are growing concerns about a potential recession, with some strategists warning of a possible 12% drop in the S&P 500 to 5,000. Due to rising unemployment and economic slowdown. In terms of tariff uncertainty, ongoing trade policy uncertainties, including impending auto tariffs, have led to analysts to reduce their S&P 500 forecast for 2025, with Barclays adjusting its projection from 6,600 to 5,900. Investor sentiment. The disparity between bullish earnings projections and a weakened economy suggests a potential misalignment that may resolve through their improved economic performance or downward adjustments in EPS forecasts. So first, looking at the S&P 500, we'll look at the long-term trends. I've got the monthly, the weekly and the daily. It's a bit of a colourful chart here. I've changed the formatting, and this is to show where the price is above the moving average. It turns green. It turns red when the price is below the moving averages, and it's blank when it's the moving average is below, or the price is below the moving average, but the moving averages are still increasing. So you want to see the price and the moving averages turn down to be bearish, and the moving averages to turn up, and also the price to be above those to turn bullish as well. The same goes for the CCI. When the moving averages are broken to the downside and the CCI is below it, it's red. And likewise the opposite when they're above the moving averages. Okay, so basically where we are at the moment on the monthly, it's somewhat bullish on the price, but notice it's turning red or bearish on the CCI. And what I've done here, I've drawn this target range, hasn't reached it yet. It's assuming the price keeps declining from where it is at the moment. And that target range is a Fibonacci retrace of the 23.38% level. So if I move that there, just zoom in a bit, you can see there that's at 23.38% target range, or that Fibonacci range, and we take it back to the previous low before that divergence started. So currently it's bearish on the CCI, but somewhat breaking down, not quite neutral yet, but breaking down towards that moving average range at the moment on the monthly. On the weekly, it's already broken down, broken below that target range on the weekly chart. Again, that's an independent divergence compared to the monthly. Different time frames are independent. You can see there we had another bearish divergence there on the CCI versus the price. Broke down, hit our target, and currently it's in a bearish momentum on both the price and the CCI, so bearish on the weekly. It also was bearish on the daily. Hit this resistance up here at 61.47. Broke down, it was bearish during that period, then it finally broke into that moving average range on the CCI. And at the moment it's somewhat bullish on the CCI, but still bearish on the price chart. So avoid trading long or short on the lower time frames if you're trading on the intraday. Now, if we go to the intraday for a moment, you can see here you would not have taken any long trades, as I said, on the lower time frames, even though that would have shown some profitability during this period going long, and then some slight profitability going short here. But again, I prefer to trade when in the direction of the higher time frame. So you would have taken these short trades during this period back here when both the CCI and the price are aligned. So to show you what that looks like for the back testing, what I've got here, this back testing here was started back when the CCI and the price broke below, indicated by this red or pink area. So that was where the back testing would have started back here. So this is a stop loss approach. So entering and stopping out, and stay tuned to the end of the video to see the trading parameters. And this is the average down approach. And what I've got here on the X's is where you would have stopped both trading strategies, or it depends which one you were trading. Where that CCI broke into that moving average range, that's where you would have stopped it according to the hourly trading. Now you can see here the stop loss approach at that point would have generated $483, and the average down approach would have generated $9,739, both starting with a baseline of 100,000, allowing for just a drop below that. and that's because the average down approach added a few more contracts and helped improve your profitability. Now you've got to make sure you've got enough in your account to allow for any drawdown. In this case, there was not much of a drawdown to account for, so you would have been okay in that. And that's why I'm choosing to trade in the direction of the higher time frame, to avoid trading opposite that trend. So you would not have gone long during this period on the hourly. So here we have the NASDAQ on the long-term trends. You can see they're a very similar story to the S&P. On the NASDAQ, it's broken. I've drawn a target range here, the 23-38% level. We've got a very long-term bearish divergence on the monthly. That hasn't quite hit the target range yet, but we'll keep an eye on that. On the weekly, that's currently bearish, with both the price just current week. At the moment, we see that candle there, long wick, and it's still bearish at the moment, break down to the bearish side. So both the moving averages of the weekly and the CCI are broken to the downside. And on the daily, we've got also a break to the upside. So again, similar to the S&P, bearish on the price, but the CCI is showing us a divergence here as well. So, or not a divergence, but a break to the upside on the daily. So avoid going long or short until we see this continue to the downside, possibly to continue your short trades on the intraday. So if we go to the intraday chart, again, avoid taking long or short trades, and you would have taken only short trades from this period back here. And I'll show you now the back testing. So again, very similar to the S&P, this is the NASDAQ 1 hour back testing. So on the stop loss approach, again, starting from this period from the daily, when the price and the moving averages were broken to the downside, likewise the CCI. So the stop loss approach, and you would have stopped it out when the daily broke into that moving average range at that point there, indicated by these crosses. So on the stop loss approach for the back testing, you would have generated $526, and for the stop loss approach, that would have generated $4,354. Again, only because you would have doubled up on your contracts during those periods. So again, stop out close the programs or stop the trading when you hit these periods there, when the daily goes against you into that moving average range. So here are the back testing or trading parameters. So if you're trading on the 1 hour time frame, you invest per trade 1 contract, the first contract entered, and you average down limit of 15 contracts. So basically the contract entries, the first one is 1 contract, next lot is 3. You've got a total of 3 contracts now running. Add another 4, you've got a contract, 7 contracts running, add another 8, and then you've got a final of 15 contracts maxed. And every time you average down, you make sure it drops by at least 0.005% for a 1 hour trade or contract parameter. If you're trading on the daily, the average down is 5% decline. Now, trading shares is very similar. Invest per trade $1,000 per trade. So you invest first $1,000, next lot is $3,000, next is $7,000, and finally you got the max of $15,000. And again, average down by 5% if you're trading on the daily time frame, and take profit of 3%. If you want to follow the traditional stop loss strategy for trading CFDs on the 1 hour time frame, you invest 1 contract per trade, take profit of 0.003% or 3% for a daily trade if you're trading on the daily time frame, and a stop loss is when the CCI 150 turns into the moving averages. Likewise, if you're trading shares, if you're trading on the daily time frame, invest per trade $1,000, take profit is 3%, and again, stop loss when the CCI 150 turns into the moving averages. Obviously, you can invest more than $1,000 in any of these trades, but you've got to be very careful of the your money management and your account balance. And I've limited it to 3% take profit on the daily and 0.003, the equivalent for the 1 hour time frame, because I found if you make it too high, in other words, if you aim for a 5 or a 10% gain, often you're a lot longer in the trade than you really expected, and it just gives you a lot more turnover when you're the smaller take profit return. To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.